Hi, everyone. My name is Tom Puro. I'm a wealth counselor here at Osborne Partners. And since 2022 has been a volatile year, what I'd like to do over the next few minutes is cover two important subjects. The first of which is why it's important to stay the course, and the second of which is how can you use some of this volatility to your advantage. Now, the first thing to remember is that when it feels really bad, that's when investors are paid the most to stay the course. Now, for U.S. stocks, the S&P has fallen over 20% to start the year. It's the worst first half to a calendar year in over 50 years. Technology stocks fell even more, with the tech-heavy NASDAQ falling over 30%. And it seems that every time we turn on our news or scroll through our phones, or if you're old-fashioned like me, you read through a newspaper, there's bad news. Inflation, rising interest rates, risk of recession, etc. It's seemingly endless. So given all of this, it's understandable that investors can become unsettled. And investors become unsettled enough, there's a strong desire to bring relief and sell stocks. Now, while selling stocks can bring relief, that relief is often temporary, and it comes along with a hefty price. And history would show that volatile periods like this are when investors are rewarded for staying the course. Usually, when consumer and investor sentiment are negative, historically, markets have delivered some of their best returns. And there are a number of indexes and metrics that demonstrate this phenomenon, known as contrarian indicators. And I often refer to the Consumer Sentiment Index, which is what you see below. And what this particular chart illustrates is the University of Michigan's Consumer Sentiment Index, along with the S&P 500's subsequent 12-month returns. And what I always encourage clients to think about is comparing 12-month returns when consumer sentiment hits a high and when it feels really good to invest. Generally, observations at the top half of the chart, relative to returns when consumer sentiment is low and it's painful to invest, which are the observations at the bottom of the chart. And you'll certainly observe that the returns in the lower half of the chart, or when there's low consumer sentiment, are much higher. For instance, in March of 2003, when you're emerging from the dot-com crisis and the September 11th attacks, and sentiment was low, the S&P 500 returned over 32% in the next 12 months. Or in April of 2020, the depths of the COVID-19 pandemic, consumer sentiment had plummeted. However, the S&P 500 returned 43.6% over the next 12 months. The takeaway here is that historically, when it feels the worst, you can be rewarded the most for staying the course. Now, the second subject we're going to cover today is how you can use this volatility to your advantage. And though every client situation is unique, a partial Roth IRA conversion is a common and powerful tax planning strategy during volatility. Your wealth counselor can guide you through the process, provide additional color and context, and help you determine the optimal amount to convert from a traditional IRA to a Roth IRA. But as a quick refresher, a Roth IRA conversion has a primary objective of reducing your retirement account tax liability over the course of time. To do so, the owner of a traditional IRA will convert part of their traditional IRA, which is pre-tax, meaning you owe taxes when you take money out, to a Roth IRA, which is post-tax, meaning investments in a Roth IRA grow tax-free and are withdrawn tax-free. The key to a successful Roth IRA conversion is converting your traditional IRA at a time when either your personal income tax is relatively low or the investments you're converting are relatively low or have a high risk reward. A Roth IRA is particularly advantageous during periods of volatility because converting after markets or individual stocks have declined, you can convert the same number of shares just at a much lower tax liability. Now, for instance, let's assume you wanted to convert 1,000 shares of Apple to a Roth IRA at the beginning of 2022. You would owe taxes on $182,000 worth of Apple shares that you convert. Alternatively, if you were to convert 1,000 shares of Apple to a Roth IRA on June 30th of 2022, the tax liability would only be $131,000. The benefits here are twofold. Number one, the tax liability generated is 23.7% lower. And then number two, as the market and Apple recover, all the growth will be tax-free in the Roth IRA. So if a Roth IRA conversion makes sense for you, The Osborne Partners team would be happy to identify the optimal holdings for you to convert and take advantage of this volatility. Now, this is just one of the many ways Osborne Partners can help you capitalize on the market volatility to reach your long-term goals. So thank you again for watching, and hope to see you all again soon.